Right, so for this example, if we follow the consolidation process, again, no adjustments necessary for different reporting dates and accounting policies. We combine the balances and totals on the line items in the consolidated financial statements and still no business combination valuation journals because we haven't done Chapter 7 yet. Before I do the timeline where we analyze the movement in retained earnings, for this example, I'm first going to do the at acquisition consolidation journal entries as there's a specific concept you need to get at this point. So the category of consolidation journal entries is the at acquisition journals, and the first one is for the ordinary shares. The ordinary share capital plus the retained earnings of the subsidiary needs to eliminate against the investment by the parent and the non-controlling interest measurement amount. And in this example, NCI was measured at a fair value of 52,000 Rand, and the parent's investment is 120,000 Rand at the cost, representing the consideration paid. But there's something big happening in this at acquisition consolidation journal entry that you haven't seen before. Whenever you are working with cumulative preference shares, you always have to ask, when you're working with retained earnings, you always have to ask whether some of that retained earnings of the subsidiary isn't perhaps attributable to the preference shares as well. And the reason why we have to ask that when it's cumulative preference shares is they are entitled to a preference dividend annually, regardless of whether that dividend was declared or not. So the moment you moved into a situation where the cumulative preference dividend is in arrears, there's portions of the retained earnings of the subsidiary that have to be attributed to the preference share equity participants as well. And the reason you do that is not because the subsidiary already has a current obligation for those dividends. There's no shareholders for dividends for any preference dividends in arrears. The only time you end up with shareholders for dividends is once dividends are declared. Up until that point, even if it's cumulative, there's no shareholders for dividends by ACE. There's no liability for those dividends. That's not what I'm talking about here. I'm talking about the portion that's attributable to these preference shareholders, what they are entitled to, should this company, the subsidiary, liquidate. Because if the subsidiary liquidates and your cumulative preference dividend is in arrears at that point, the preference shareholders will get more than merely their capital outstanding. Then they are also entitled to their dividends in arrears as a portion of the net assets of ACE. So in this example, we said at acquisition date, the X7 and X8 preference dividends was in arrears. So of that 27,500 at acquisition date, there's 2 years annual fixed dividend that's not attributable to your ordinary shares. It's attributable to your preference shares. So you ask that 27,500, who is that attributable to? And if there's a cumulative preference dividend in arrears at that point, it is attributable to the preference shareholders. So you'll move that amount out of the ordinary share analysis into the preference share analysis. So when you write the at acquisition consolidation journal entry, only the 7,500 will be part of the at acquisition equity attributable to the ordinary shares. And as a result, comparing what the parent was willing to pay for his portion, the parent's measurement of NCI to the net asset value of the subsidiary, you end up with goodwill in this journal entry. So if we look at the acquisition consolidation journal entry now for the preference shares, you'll pick up on the following. It is the preference share capital that eliminates in this consolidation journal entry of the subsidiary. And now you have an item here that you haven't seen in example 8.1. That 20,000 Rand represents the X7 and X8 annual fixed preference dividend that the shareholders are entitled to. That is now a portion of the retained earnings of S that we attribute to the preference shareholders. So you have that item that also eliminates, and remember, of this total equity at acquisition date, a portion eliminates against the investment made by the parent, and a portion moves to NCI, where they are measured at a fair value of 75,000 Rand. As a result, in this at acquisition consolidation journal entry, we have a gain from bargain purchase. You will only see this scenario where a portion of the retained earnings of the subsidiary at acquisition date is attributable to the preference shareholders when they are cumulative and when their preference dividends are in arrears at that point in time. Remember, the moment you become a shareholder of a company, you become entitled to those dividends that are in arrears. Something I would like you to see is if you compare the two at acquisition consolidation journal entries, you are still eliminating all the at acquisition equity of the subsidiary. You are eliminating the ordinary share capital and the preference share capital, and then you are eliminating the full 27,500 retained earnings at acquisition date. You are merely splitting that amount between the equity participants for purposes of calculating your goodwill or gain from bargain purchase. And then, as we've discussed before, the moment you have goodwill from the one at acquisition elimination and a gain from bargain purchase from the other at acquisition elimination, you now know that those two amounts have to be offset for purposes of presenting only one net amount in the consolidated financial statements. And to achieve that offsetting of the goodwill and the gain, you have this consolidation journal entry number 3, where you debit the gain against the goodwill. The reason why we debit the gain is the smaller of the two amounts, and that offsets against the goodwill. Please remember, it can go either way. You can have a larger gain from bargain purchase, then the goodwill will net off against the gain. You can even have goodwill from both, or gain from bargain purchase from both. When that's the case, you merely add the two amounts together and present one amount in the consolidated financial statements. Before I now look at the intra-group and the since acquisition consolidation journal entries, I would again like to make use of a timeline to show you the effect and the decisions you have to make and the amounts you have to calculate.